Just going to give people a moment to join as we get everyone in the webinar. So we'll begin momentarily. All right, welcome everybody. Thanks for being with us for our quarterly economic and market update. Glad to have you with us, and I can't believe how quickly the year is going by. We're already more than halfway through 2021, and lots to talk about. It's been a great year in the first half. So we're going to talk a little bit about what's been going on. Let me introduce our speaker. Besides myself, I'm Chris Boyd, the firm's founder. Thanks for being with us. Brian Regan, our firm's Chief Investment Officer, is also going to be presenting today. Give you a little overview of what we have in mind. We're going to, I'll start with a few introductory things before I go into this. I want to just remember to mention to you all that in addition to our comments today, we post a Investor Insights newsletter for our clients. We will be sending those out momentarily. They're actually being produced and sent out today. So you'll be getting those by mail, and we'll post them by email or to your portal as well. And if you don't know, we do these webinars quarterly. We do not only this market and economic outlook each quarter, but we also do a financial planning topic each quarter as well. So we'll be doing one in September for that next, and we hope you'll join us for those as well. When it comes to our meeting with clients, I just want to let everyone know we'll be talking a little bit about how COVID is affecting markets and so forth, but we are at a point where the team at Asset Management Resources has been vaccinated. And for those who are vaccinated, we are happy to have you meet in the office if you'd like to meet with us in person, as well as continue the opportunity for meeting virtually. So whatever your preferences are, we're going to be able to continue to serve those interests. All right, let's jump into our plan today. We're going to start by reviewing what happened in the second quarter of the year, how things are going with the markets, a review of the first half with our portfolios, a little bit of an update with COVID-19. As much as we'd like to put it behind us, it's not quite out of the minds of investors. So we have to be talking about that too. Inflation is something people are concerned about, so we want to touch on that, give you a sense of our views. We'll talk about the growth and employment considerations, economic indicators, and investment evaluation, and of course, our takeaways going into the next quarter. So let's jump in.
So as usual, I want to do a review of the quarter that just passed, see what moves we made, how they did within the quarter. Were they value add? Were they neutral? Or did they detract from the portfolio? Q2 was a great quarter. So we determined last quarter that there was going to be a large fiscal stimulus, and we expected household savings to be spent over the next couple of years. So that led to a few changes, including increasing consumer discretionary position funded by our high yield position. That was very positive. The consumer discretionary has been far more volatile, but since the third week of April, which is when we usually make the changes in the third week at the beginning of each quarter, and through July 9th, when I pulled this data, the consumer discretionary outperformed the high yield by 1.38%. We increased our real estate position, and we funded it with investment grade bonds and gold, and that was very positive for us. Our real estate position far outperformed gold in the third week of April until 7/9 by 3.8%, with far less volatility. And gold slightly outperformed the investment grade bonds, but with far more volatility. So gold was much more volatile than investment grade bonds, but had done slightly better up until that point. We continue to overweight in risk assets. So we've been slightly over our target. So if you have a 50-50 portfolio, you might notice that you have 51, 52% stock. But you also have things in there on the fixed income side, like preferred stock and maybe a more high yield than we might typically have to take advantage of the opportunity that we've had in the quarter. And quite frankly, stocks had an excellent quarter and risk assets had an excellent quarter. So it was positive all around. I'm very happy with the quarter. I'm really happy with the first half of the year, as we'll see. So we got this great new tool that called Y charts, and one of the great new benefits of Y charts is we get to load in our model portfolios. So essentially, our asset allocation, our intended asset allocation since the beginning of when we have data for the 30-70 portfolios, it's 3+ years. For the 50-50 portfolios, it's 3+ years. And we have about 2 years of data for the 65-35 and the 85-15. And what I want to share with you now is how that's done against our internal benchmark over the first half of the year. And hopefully this is something that if you're confused with, we can start to share with you on a more personal basis on how you're doing and how we think we're adding value. Before I get into that though, I do just want to glance over what the major asset class first half performance looked like. And these are the kind of charts that this program that I just mentioned can give us. And I think it's a great value add and just another tool that we can do to enhance, the service that we're providing you. The all stock market performed 14.93% over the first half. High yield is slightly positive at 0.85%. Investment grade bonds were negative 2.73%, and gold was negative 7.14% throughout the first half of the year. So this highlights that our overweight to stock was great. Selling of gold was also a good move. And I just wanted to highlight that as kind of a general overview of some major asset classes. Now getting into some of our specific strategies. This is our 30-70 mutual fund and ETF portfolio or model portfolio throughout the first half of the year. And so net of fees, we outperformed the internal benchmark by 0.54%, and it returned 3.38% overall. I mentioned that stock has done very well, especially relative to bonds. So the more stock that we were going to have, the more outperformance we're going to have. And you'll see that for as we move up to the 50-50 to 65-35 and the 85-15. I want to mention that the benchmarks are a combination of the All Country World Index, which is a general stock index, the aggregate bond index, which is a index similar to the All Country World Index, but for bonds, and a money market fund. For the 50-50 portfolio, we net of fees outperformed the internal benchmark by 0.66%, and it returned 6.2%.
Again, just to reiterate, I think you mentioned this, but we're assuming a 1% fee for these assumptions. Clients may have a fee that's a little larger, a little smaller. It can vary, but it's probably a good indicator of what might be a good estimate for typical costs.
Yeah, so our 65-35 portfolio net of fees outperformed the benchmark by 0.81%, and it returned 8.38%. And the 85-15 portfolio net of fees that outperformed the internal benchmark by 0.93%, and it returned 11.25%. So Chris is going to take over for the next few slides and explain what we're seeing through COVID-19 and the recovery update. I think it's good for Chris to do this because I'm exhausted by talking about it. I was really hopeful that this quarter we wouldn't have to address it, but yeah, I think we still do.
Yeah, good point. There's so much hope that as we become more vaccinated, we will have less of a concern with this. And, I think this is one of those challenges that we face, though. And we see in different states the rate of vaccination or, that we expect will create this immunity. It varies. And as people seasonally, this may be something that is affected. Of course, more outdoor activity may be beneficial. And so as time passes, as we move into the fall, will this be something we have to worry about? Having, the numbers look, this is pretty attractive that we're getting more vaccination that seems to make this less likely to be a concern for our business interests and therefore, stock market considerations. But it is not just something that's here in the United States that we have to be mindful of. As the disease can travel across borders, we have to be mindful that the vaccination rates across the globe are also relevant to determine whether or not this disease will continue to spread and mutate. Brian, why don't you hit on the highlights of the country aspects of this?
Yeah, so what we've seen is in certain countries, particularly the UK has been a big one. We've seen rapid increases in the Delta variant, and it's spreading again. So we saw cases in the preceding 7 days, and that last number 21 in the UK was 170,000, and in the most recent 7 days, it was 218,000, or an increase of 28%, which is very significant. The good news about this is a large part of the country is vaccinated, but they're vaccinated with the AstraZeneca vaccine, which isn't as effective at preventing COVID spread as Moderna and Pfizer, but it is pretty effective at keeping people out of the hospital and keeping deaths low. So even though that they're having quote unquote a third wave, the deaths at least are low, and you're seeing the UK actually continue to open up. Now, they're not alone. You can see in Russia, they're having similar issues. But I also want to point out there's in the United States and certain states we're having similar issues. But India, for example, has billions of people, 1.4 billion people, in China, and they're getting better. Or China's just good. I mean, very few cases, and India is getting better from a very, very poor situation that they were in. So, overall, from an economic standpoint, I don't see any supply chain constraints here, but I do think that it's important that we see some progress one way or another. I mean, I do think we're going to get to, maybe this slide's better. I do think we're going to get to herd immunity at some point. Unfortunately, it's probably more likely, I think, at this point that it's going to happen through disease rather than through increased vaccinations.
One of the good things, though, is on the next slide that where we can see that who's really been vaccinated in the United States is heavily, focused on those who are most at risk. Older populations have embraced the vaccine, and that should bode well for death rates and for hospitalization, as it seemed as though older population is most at risk from this disease. So, what does that mean? I think that the takeaway from that's encouraging is, as much as we may not be done with COVID-19, and it may continue to spread throughout our population, it does seem less likely to be a disruption to with shutdowns and things of that sort, where if death rates and hospitalization rates are able to be contained, we may not have the concern or the appetite as a society to deal with isolation and shutdowns the way we had over the last year.
So the hot topic has been inflation, and in the Investor Insights letter that Chris talked about at the beginning of the presentation, I do spend most of the letter talking about inflation and trying to provide an analogy that makes sense to everybody, and trying to describe where I think things are going from here. I'm going to try to do that in a little bit more detailed fashion here in the next few slides. If you pay attention to our quarterlies regularly, I think we're on the same track as we were last quarter, when I think I made the case that I expect inflation to be transient. And I know at the beginning of the year, I said I highly expected that there would be inflation and that the headlines would be strong. And that's exactly what we've seen, quite frankly. And it hasn't changed my opinion that this is going to be transient. But I do think we're going to see slightly higher than normal inflation, and that's not necessarily a bad thing. So this is what I'm talking about. So here's the orange line is the U.S. core PCE index. I use core PCE, excludes food and energy. Food and energy are typically excluded by the Federal Reserve because they are very volatile and don't give a good indication of long-term inflation trends. The U.S. core PCE index year over year is the purple line. And as you can see, we had a sizable jump. Now, the purple line is what likes to get thrown into headlines. Actually, they like to use CPI and not core CPI. They like to use regular CPI, which is even significantly higher, which is intentionally misleading by news organizations. I just like to say that. And when we look at core PCE, we're running a little bit hotter than normal at about 2.45% annualized rate. The Federal Reserve has told us that they expect this, that they're okay with it. And with time, over the next 12 to 18 months, I'd say that they expect it to come back down towards their target of 2%. I think this is worth monitoring for sure, which is what we're going to get into in some of the next slides. So, this is something that this is a chart that I'm trying to represent why I think inflation could be something to be concerned about in the future. I think it's, investing and predicting data is very rarely black and white. It's normally a probability base. So I would say there's a higher probability that we're going to have transient inflation than an inflation problem. But here's some evidence on why I think, you could see some elevated inflation, which again, isn't necessarily a bad thing. US real GDP is catching up to potential GDP real quick. So potential GDP is the estimated rate that the gross domestic product in the United States can grow at a given time. And it's a basic measure of how much capital, how much labor, how much productivity is in the economy. When we have a recession, US real GDP falls significantly lower than potential GDP. And towards the end of the business cycle, we go above potential GDP. And that's when you usually see a little bit of inflation. That's when you see a full employment market. I do expect, and I think most economists would agree, that US GDP is going to surpass US real potential GDP very soon, which isn't typical in the normal business cycle. Now, just because US real GDP surpasses potential GDP doesn't necessarily mean we're going to have inflation. Now, you can see that if you look at the purple line and the blue line and you just compare them from 2018 to 2020, the economy ran hot and we did not have significant inflation. What we had was a very comfortable economy. So just because we run a little hot to potential GDP does not necessarily guarantee that we're going to have inflation, but it does mean that we're going to have a higher risk of higher inflation. I think there's another item that's been in the headlines, and I think for good reason, has been the housing stock and housing prices. And I'm going to try to address that through a number of different ways throughout this presentation. So if this is something that you're paying attention to, hopefully I'm going to address it and give you an idea of where I think that the outlook's going to be. I think this chart's very interesting. So if you look at the red lines, this is from Redfin. This is all housing new listings at the top. And you can see that during the pandemic, the new listings fell dramatically from the norm. The other lines are previous years. The orange line shows that we've recovered pretty dramatically back to the norm. The bottom line show the year over year. It's a little easier to read. You can see that we fell 40% on new listings in all Redfin metro areas. And then the orange line, we dramatically increased back up to 60%. So, housing prices, part of the reason why they were running out of control in 2020 and in early 2021 is because nothing was for sale. And there's some good reasons for that. Do you really want to have an open house when people could bring COVID into your house? I mean, I think there was a legitimate fear there. And what we're seeing is that's loosening up a little bit now as we get into 2021 and the economy is opening up. So this means there should be more houses for sale, which should add supply to the market. Now, lumber futures, this has been another top headline thing. People can't build because lumber was so expensive. Again, I think this is misleading from news organizations. If they spent any time learning about the lumber market, they would know that this was going to collapse. This was essentially a short squeeze where lumber yards contract out 90 days typically for builders, but they don't hold 90 days worth of inventory. They expect it to get shipped in from mills. Mills can basically produce almost unlimited amounts of material, and the bottleneck is actually in the forest in the Pacific Northwest. So this was inevitable. Lumber futures fell dramatically. Wood is priced normally today. I pulled this chart about a week ago. If you looked at it today, it would be well below 750, which is probably the top line of a normal market in the lumber patch, for lack of a better word. I looked at it yesterday. It was about $585. Seeing a similar story in copper. So these commodities, they really peaked in May, and they're starting to come down. This suggests the transient nature of prices, as we've been describing. Growth and employment.
Before you jump into that, Brian, I just would like to remind our listeners and participants, if you have questions as we go through this, you're welcome to either place a question in the chat bar or the Q&A. We'll try to address them at a later part in the program. Thanks.
Yeah, I did notice there was one in the Q&A, so that's great. We really love questions, and I'd rather this be engaging to our clients than just a lecture. So growth and employment. When employment is really tight and wages are high, we should expect more inflation, but we should also expect a nice, comfortable economy. When unemployment is high and people aren't working, should be the exact opposite. It should kind of keep a lid on inflation, but it also isn't the most ideal thing for society in general. So what are we seeing? Well, this is a chart on growth. This is called the Weekly Economic Index. It's basically a real-time estimate on GDP that the Federal Reserve does. And what they're expecting is around 7 to 10% GDP for the next quarter for Q2, which is gangbusters GDP. Do I expect this to last? Of course not. Our potential GDP should be around 2.5%, 2 to 2.5% normally. But this is recovering from the dramatic lows that we had in 2020. The exact same kind of story that I've been talking about with inflation. We were so low in 2020 that now that we're recovering, it's inevitable that we're going to be so high. Now, employment hasn't really caught up. So the U.S. unemployment rate is still a little bit elevated. You can see prior to the COVID pandemic start, really, of the shutdowns, we were at a low of 3.5% unemployment. Now we're at 5.8%. The U.S. labor force participation rate, I like to do prime age, and I define prime age as 25 to 54 years old because I want to exclude children and I want to exclude retirees. We still need about over 2 million people in the workforce to get back to normal. Now, there's obviously a number of reasons why this is the case. Extended benefits, lack of childcare, and continued fear of the virus are all the main cited reasons. And this makes a lot of sense to me. In the continuing unemployment claims and initial unemployment claims, we're seeing a similar story on the prior side. Things have gotten a lot better, but they're not back to normal yet. Now, the one benefit to having high unemployment is there's a lot of room for improvement. Your best historic returns come if you invest at the height of unemployment rather than the low. So all this economic data is good. It's trending in the right direction. But it could actually be more negative for risk assets in the short run, at least. Now, I'm doing a lot of debunking of major headlines in this presentation. I do think there's a lot of, even though they use real data, I think they cherry pick data in news organizations quite a bit. Whether they're doing it for shock effect or because they don't understand the data, I think is to be debated. But people like this. There's this narrative that wage growth is out of control. It's just not the fact. This is the actual data from the Federal Reserve Bank of Atlanta. Low skilled workers are getting raises. That's where we're seeing the increase in wages. And while mid and high level are being stagnant, but mid and high level wages didn't fall during the pandemic. We could all, arguably my job is a mid to high skill job, and I just continued communicating with all of you through the internet. But low skill jobs couldn't do that. So they were either unemployed or obviously taking more or less hours, or taking more of a risk going to work. So we have seen an improvement in the low skilled workers wage growth. I think that's probably a good thing for the economy, because lower wage workers tend to spend more rather than save, which is what propels our economy. All right, I'll go through some economic indicators.
Can I just comment on something there, just to
Sure.
summarize? So I think, you covered a lot in that last section, and I think it's a lot of great information. One being that, yes, inflation is a factor, but if we look at it over a little bit longer time frame, it's not as dramatic as it might appear in the headlines, number one. Number two, something to be watched, though we think it's not likely to be the worry today. Have to watch it though. Another point that I thought was really important is that there's still slack in the economy when it comes to the employment data you provided. That's what gives us reason perhaps to think that inflation isn't just going to be runaway and right? Fair enough. Those good.
Awesome summary, Chris.
Okay.
So let's go through some economic indicators, and I usually do get into the weeds. So Chris, if you want to give another summary before we get into your part, I think that'd be awesome. So I talked about housing a little bit based on existing home data. What's for sale? We had a big detraction in 2020. We had a big increase in 2021, back to the norms. I think another narrative has been new houses haven't been built because of lumber. What this data is basically telling you is that narrative is also false. New housing permits have been pulled at large rates, unlike what we've seen over the last 5 years. And U.S. housing starts have also been very robust. So directionally, this means that through the next 9 months, it's an indicator that the economy should be pretty good. Sales, durable goods, and inventories. We've seen a huge run up in retail sales. And this is in large part because of stimulus and increased benefits. People are spending money. People are buying things from Target, Amazon, Costco. I follow those individual stocks as well, and the same source sales are off the charts. So this is economic data, but that's anecdotal data from those particular stores. Durable goods are, again, incredibly off the charts. So I actually expected this to come back to earth a little bit, because I thought during the pandemic, we were going to see, everybody ran out to get a Peloton, and maybe don't necessarily need a Peloton if they can go to the gym. But we haven't seen any let up in that at all. In the U.S. inventory to sales ratios, people still need inventory. They can't keep up with the amount of demand that's there right now, which, granted, to Chris's prior point, is a inflationary data point that's worth monitoring. Personal savings, I alluded to this prior. Stimulus comes and American spend. We used to average around $1.2 trillion in savings due to the pandemic, people not spending, and because of increased stimulus, we now have about $4.25 trillion in spending. So this is one of the in savings. So this is one of the reasons why we've been emphasizing consumer discretionary positions and small cap positions, because there's just a lot of cash available for people to spend.
And that's ultimately bullish, right? For the net result.
I want to talk about demographics for long-term growth expectations, right? So one of the things that I want to point out here on the left-hand side chart, you can see that the 10 most common ages in 2010, the most common age was 50 in 2010. And in 2020, the most common age is 29. So what are we seeing? There's a coming of age of the millennial generation where they, in the next, then it's 30, then it's 28, then it's 27, then it's 31. This is the age group that spends money. They're coming into their prime working years, and they have the ability to, buy a house, furnish it, etc., have children. And that wasn't the case in 2010. So we have this demographic tailwind that's keeps me optimistic for the longer term. Now, on the right-hand side, this is an age distribution difference. What we're seeing is the boomer generation is growing. Between 60 and 80 is a fast growing part of our demographics. These folks typically save more, typically buy more bonds because they need to de-risk in their portfolio, which could keep a lid on interest rates for one. But the other thing that's important is what's the other positive change group there is the 30 to 39-year-olds. So it's reiterating what I said in the prior chart. Now, the final thing I want to bring up here is the 0 to 9s, the 10 to 19s. People just aren't having children like they once did. Particularly the boomer and millennial generation. Boomers had children and millennials haven't. But what I think as the millennials come in age here and start building families and start having houses, you might start seeing a sea change in that demographic too, which could guide what kind of holdings that you want to have for the long term. I think this is another thing that might make you want to hold on to small caps and consumer discretionary type stocks for the longer term. So I'm going to hand this over to Chris, this investment evaluation in equities and bonds, if unless he wants to comment on the prior
it's just,
slide.
I think, you hit savings, spending, and demographics all point to favorable indications for stocks over the foreseeable future right now.
So Chris, you want to take over the investment evaluation here? You do a great job of explaining these charts.
Thanks. This is a great chart from from JP Morgan Asset Management. They do a nice job kind of indicating what's the forward-looking price to earnings ratio and putting it on a chart like this. Essentially, again, what's a PE? It's essentially looking at what are the earnings of a company relative to its price. And in this case, it indicates that, as of July 9th, there's a 21 times the earnings, almost 22 times the earnings to get to the current price. So that does seem a little bit elevated relative to historic averages and numbers. But keep in mind, we have had some pretty big disruptions in that period of time. And I think it ultimately bodes to the point that Brian, I know, is going to talk about, is the idea that stocks really will be watching their earnings and how that affects prices. And ultimately, there's plenty to be happy about, that we've had good runs. We don't necessarily think that stocks are exceedingly overpriced, but it's something we have to watch for. And Brian, why don't you take it for here to elaborate on that point about the importance of earnings as we look ahead?
Yeah, I just, the point I want to make here is oftentimes people say, how much further can stocks go? Like there's a lid, there's a limit, there's a ceiling to how high they can go without them falling. And I say constantly that stocks are a function of earnings and interest rates. And what you can see here on the right-hand side, the gray bar shows earnings growth. And we've had north of 20% earnings growth. And the S&P return's only been 16.3%. So we've had a little bit of contraction in the multiple expansion because interest rates have gone up. So this is just a very simple way of kind of showing that exact dynamic. Now, on the left-hand side, those bar charts, you can clearly see that earnings keep going up. It starts in 1988 and it forecasts out through 2022. And you can see that there's a dramatic change in the earnings. So I expect the U.S. economy to continue to grow, to continue to increase earnings. And there's no necessary reason that you should think in the long term that we're going to have this dramatic change in the stock market.
It's a great point. Just that is a question that comes up a lot is, should we be worried because we're hitting new highs? And that doesn't mean there won't be future new highs as well. And your point about interest rates being low as to what's the alternative is a great, comparative point.
Yeah, I only want to touch on the yield curve quickly because it's a difficult topic to understand. But the steeper it gets, the more optimistic, generally speaking, bond investors are about the economy. And what we're seeing here is the blue line is the most recent bar that I have in this chart, and the yield curve is getting steeper. So there's some general optimism. Now, for our bond side of our portfolio, I like to target the steepest part. I think that's the most rewarding risk return dynamic. And that's as far as I'm going to get into that for this purposes. But if you really want to get into the nitty gritty of the yield curve and why I look at it and how I use it to position portfolios, I'm happy to have that conversation. In fact, I'd kill for it. I'd love to have that nerdy conversation.
Maybe just one comment that I could have you offer is how our bond positions are relative to sensitivity to interest rate, our duration risk. Give people a sense of the limited risk we have there.
Yeah, we take around 4.5, 5 years, which you can see is the steepest part of that curve right there. And in a basic sense, that means if U.S. Treasury goes up by 1%, the portfolio will lose 4%. And there's no guarantee on that either because there's something called spreads as well. So if the yield curve is going up, then sometimes you'll get spread contraction and it won't quite be 4%, and you'll get paid an interest rate. So bonds, we fielded a few questions about people being concerned about interest rates going up and what will that mean for their bond portfolio. It's just good to know that bonds are significantly less volatile than stocks, significantly less. You're likely going to get some interest and you're going to get some capital preservation. And if you marry your bonds with your stocks, you're likely going to get a better risk-adjusted return in the long term.
Let's just invite everyone one more time. If you'd like to ask a question, we're just going to be summarizing our takeaways and then we'll have time for questions. So if you'd like to either raise your hand, put in a question in the Q&A or in the chat, we'll be looking for those.
So the economy is continuing to grow with the Delta variant being a risk. The inflation continues to look transient, albeit at a higher than normal historical rate. And I don't think there's anything wrong with that. And we can discuss that further if you're interested. The unemployment continues to be high, but this could mean that there's continued room for improvement, which could mean that, that could be bullish for the long-term returns of risk assets. Demographic trends and high savings rates provide continued optimism for risk markets. So I thought Chris did a great job of summarizing that earlier. Earnings growth needs to continue to grow to support equity prices. So, I talk a lot about how we expect earnings growth and what's the big risk that we don't get the expected earnings growth. That's the biggest risk in this market that I see. And that's a change from the persistent asset growth that's come from low rates or multiple expansions. So what we've seen since 2018 is that interest rates have fallen from around 3% to today around 1.2%. And that's really supported risk markets. And there's going to be a paradigm shift here where earnings are going to have to drive the bus. We're not going to make any significant allocation changes from Q2 to Q3. We believe we're appropriately positioned. And what we will do is make sure there's any excess cash that might be in your portfolio is going to get reinvested into the portfolio. If you have, I'm not going to rebalance it either. So if you have stock assets that have done really well, I'm comfortable with that. I want to see them float a little bit higher. So that's our takeaways. I'm happy to take any questions, and I'm just going to leave it on the disclosure pages while we start to field those questions.
One thing I think that comes up from time to time, Brian, we've talked about it in some of our other webinars, might be worth reiterating. A lot of news has been focused on the prospects of higher taxes and substantial government spending. Investors that I talk to often are concerned a little bit about how much can the government continue to increase their debts, and should we be concerned about higher taxes affecting the markets? I know we've talked about this in other occasions, but I think it's probably worth reiterating briefly.
Sure. So increased spending and cuts to taxes, or you can just say increases to the deficit, are both stimulative and inflationary. So if you want to cut taxes, if you're on that side of the aisle, know that that's stimulative inflationary. If you want to spend money and you're on that side of the aisle, know that it has the same effect. When it comes to the specific policy, you might have different effects, but directionally, they're doing the same thing. Now, if you want to raise taxes and you want to cut spending, those also have the same effects. They're detractionary and deflationary. So if we're going to spend a lot of money, which we've done, so we've actually passed a stimulus bill in March, and there's only been plans of increased taxes in an infrastructure bill and a family plan. Those have only been plans. Nothing's been passed. Nothing's even been passed by one side of the House or one side of Congress, to my knowledge. You need to keep those directional effects in mind. So we had a big stimulus, and we've had a 15% increase in the market through the first half of the year. If we have increased taxes, that's likely going to be detractionary. Now, if we have increased corporate taxes, that's going to be more contractionary to the market than increases in capital gains or personal taxes, in my personal opinion. And the reason for that is because it directly affects the bottom line of companies. If we have an increase in spending an infrastructure bill, that's going to be stimulative, but it could also be inflationary. So what does that mean? It's likely going to be good for risk assets like stocks, and it's likely going to be negative for investment grade assets like bonds and treasuries. So there's pros and cons to each, but just keep in mind that sometimes we're speaking the same language, just on different sides of the political aisle. And I don't really want to talk about the politics of it. I just wanted to communicate how I expect it to impact people's portfolios and wallets.
And I would reiterate one additional point, and that is that our clientele generally should not be, who have discretionary accounts, should not need to feel the need to be proactive in changing their portfolio themselves, because our active allocation process does some of that, where we, as our part of our decision process, will look at where's their opportunity, where's their risk, and alter the portfolio modestly within their risk profile to accomplish what we might want to benefit or mitigate risk in a given circumstance. So the bigger question is, do you have the right risk allocation? Should we be talking about your concerns to evaluate whether we have the right strategy for you, by and large? Okay, thanks, Brian. That was good. With regard to our question here, and again, I'll invite people, if you'd like to ask a question, there's a Q&A button. You can type in your question there, or if you would like to, feel free to raise your hand and we can unmute your line as well. So the question in the Q&A is, when thinking about diversifying one's portfolio internationally, how do you view investing in companies based in China or other countries that have unpredictable government actions toward business?
Yeah,
and that might be an opportunity for you to talk a little bit about our stance on international, our weights and that sort of thing as well.
Yeah, so we are underweight international stock, and that might not be the case all the time, but that's the case now. Everybody, if you have an individual stock portfolio with us, you might notice that you have you don't have individual stocks in obscure countries. The most obscure country that you might have is something like Japan. You probably have Canada, you might have the UK, you might have something in the Eurozone, but you're not likely to have something out of China. I do think that there's definitely a disclosure of information problem that comes out of particularly China, which is generally why I stay away from those individual stocks. I don't like the ADR setup, which basically means you don't really own the stock. You own a trust of something in the Cayman Islands that owns something on the exchange in China. I think it's flawed. The Chinese government has made it clear, especially with the DDIPO, that they don't necessarily want their companies that might need to share information and data with the United States to list on the New York Stock Exchange or in other capital markets within the United States. So there's a clear risk there. Does that mean that we don't have any Chinese exposure? No, but what we do in the ETF and mutual fund portfolios and what we call Series 6 individual stock portfolios is we employ an actively managed fund where they have expertise in figuring these things out. They have boots on the ground, if you will. to try to keep us away from really, really difficult situations. I don't personally have an expertise in what is going on in China, for example, so I just stay away from picking those individual stocks. But these people do, and it provides us a level of diversification. And it's relatively inexpensive, and it's performed relatively well, and we're very happy with it. And that's where we've chosen to put our chips when it comes to international diversification.
Okay. Anything else in the way of questions? I don't see any at this time. Kathy, is there anything in the chat? Brian, anything else you think we should be covering?
One question that I've been asked recently that might be of interest to folks is people think the housing market it needs to collapse like it did in 2007, 2008, 2009. A few things I'd like to stress. I don't think that's a risk right now. There's no such thing as like a ninja loan. I'm going through buying a house right now. They want everything. They want to know what the name of my next child is going to be, and I don't even know the answer to that question. Like I said, personal savings rates are very high. People can afford the mortgage payment. Even in the increased mortgage payment, we saw from a year ago the average house in the United States go from 320 to 360, but we also saw household debt as a percentage of the disposable income or household debt service fall dramatically. It's just not a problem for people to pay these debts. It's a much more high quality borrower than it was in the past. So I don't expect to have the same problems that we had back then, at least not now. I think we're actually more at the beginning of a cycle, especially if you look at the demographic trends than towards the end of a housing cycle.
Well, I imagine some of those demographic considerations you pointed to factor into that as well.
Yeah, 100%. Like that's the reason why I think we're closer to the beginning of a housing cycle than the end.
Yeah.
Chris, this question came in earlier in the presentation, so I think some of it has been answered. But someone was asking if we're doing anything specific at AMR and our portfolios to hedge against rising inflation.
Well, the best hedge to rising inflation is increasing your stock risk. So we have done that. And we also are more heavily invested into our real estate portfolio. So both those things have, coupled with the best hedge historically has been small cap stocks. We've added small cap stocks, we've added real estate, and we've increased our overall stock exposure. And those are the best things that you can do to hedge the inflation risk.
And that is also a factor in why at this time you think we're better served not to rebalance the portfolio and let some of these stocks continue to extend.
Yeah, but I just want to stress one last time that I think the tip of the iceberg has been hit when it comes to inflation. So we could still be elevated, but I don't expect the growth rate to continue to accelerate at the same rate that it's been at.
Well, very good. Thank you for your comments. So it looks like we do have one more question. Just getting it in under the wire here. Has gold been replaced as a hedge against inflation?
Well, I never looked at gold as a hedge against inflation. Gold is a global, and it hasn't been for a long time. If you look at the data, that is it used to be a hedge during inflation prior to 1979. In 1979, we went off the gold standard. So the connection hasn't been as strong. What gold is it's a global currency, and what you can do is when interest rates converge, when all the developed markets interest rates in the world, which interest rates and trade balances predominantly determine the price of currencies, of which gold is a currency. When they all converge on zero, then gold becomes very interesting to me because it's a global store of value. But we've come out of that, right? So the United States interest rates and money supply has actually been growing less quickly than it used to, where the rest of the world isn't necessarily in that situation. So now the rest of the world is flooding the United States with their excess reserves. And that's why interest rates have come down more recently. But as the rest of the world starts to recover from COVID as well, you might see a further disconnect. So no, I don't think gold is an effective hedge against inflation. I don't think it has been for a long time, for at least 30, 40 years. You know, I understand that used to be the narrative once upon a time, but it doesn't hold a lot of water to me.
All right, Brian, thanks so much for your presentation today. I want to thank all those who attended for our live version. Be aware that if you didn't catch all of it or you want to catch some of this as a rerun, we will have this posted on our website in the clients section, and we have a section for these presentations. So please do go to amrfinancial.com if you want to catch more of that or share it with other family or friends. As always, we greatly appreciate the trust and confidence you place in us. And if you have any questions beyond what we've talked about thus far, or you'd like to come in for a meeting, a review of your situation or an update on your financial planning, please reach out to us either through the office, 866-771-8901, or you can connect with us through the web address, amrfinancial.com. Everybody, thanks so much for your time. I think we can close it there.
Thanks.